Good day. Ira Epstein with your metal market wrap-up, and this wrap-up is for Wednesday, the 3rd of February, 2021. Now remember what we do here. We're going to look at daily charts in these particular videos. On the weekend, for my subscribers, those are the paid subscribers, I do a complete series of charts, 40 some odd of them, on weekly charts for the longer trades. Also for my morning subscribers, I also mix daily charts and weekly. So I just give you a flavor of what they are. The studies you're going to see are not all the ones that I use, just because there'd be too many lines to go through. I do that in my paid subscriber video. What you're missing primarily is going to be a key moving average that I use for entry at different points in the market, and you're also going to be missing the window envelopes, profit tools that I use. So those are the two, but you get a flavor for everything else that I'm doing and still the big picture. You saw the NASDAQ weak today at the expense of other bouncing markets in the indices. Metal markets a bit higher. Copper still respecting, as I said the other day, that 350 area. We know why it's weak. We know it's about the Chinese Lunar New Year coming up. But as I said, you still pay attention to Bollinger Band bottoms, and you got to one, and that was important. You're sort of doing this in the currencies, drifting on the downside with the dollar still overall stronger than them. A powerful day in the energies in the face, and this is to me very important, in the face of an EIA number that I thought was not bullish. The API number yesterday, but not the EIA. When a market goes up and it doesn't care, it's giving you a story. Bonds and notes, as I said before, and I'll repeat it to you, I still think that the market made a peak right as the Fed held its FOMC meeting and the conference. That was your rally back up, dropping rates, and they've been climbing again. As we look at the gold market, there's a constant theme here. Literally, since November of last year, the market has been staying under the 18-day average, under pressure in the marketplace. We had a rally this year, nicely. And by the way, this is a weekly area chart of just closes. So understand what we're talking about when I do that. And it's a weekly chart. This is daily, and it's very different. On a daily bar chart in April gold, we got as high at the beginning of the year into the 1960 area, got down near 1802, and have been going sideways ever since then. The market really, in the first 2 weeks or so of the year, made its range, and we've just been driven sideways in it since then. When I add to this swing lines, now swing lines are the brown line that you're seeing. It's made up of a study that I wrote years ago, and it makes life easy when I look at a chart. Any chart I put it on, stocks, options, futures markets, data that I just get from other sources for other things I'm looking at. It tells me if I'm trending and what number will break the trend. I am defining trend in a downtrend as having lower highs and lower lows. In an uptrend, higher lows, higher highs, and no trend will have something that looks like this: a higher high and a lower low. The current bar always looks at the previous day, and it looks to see if you made a lower low, a higher high, have you made an outside day down, an outside day up, or an inside day. If you take my charting course, it's all laid out, and I make you draw it by hand in the course, and then you understand what the indicators it draws itself does. So the first thing that I'm looking at is a market with no trend. That's how I define that. The second thing I look at is where is it at in relation to moving averages? Why? So many people rely on moving averages. That's why. And you want to be where the herd's looking at different things. Well, the herd in this saw a bearish crossover. I pointed this out to you right here as the market got underneath this. This was last week, January 29th. Normally when that happens, you make a new break low for the move. The market went right up. I didn't look too good there, but all of a sudden, I look really pretty smart here because it's already taken out that low of the 1830-240. One for the boys. All right, the resistance, the 18-day average up to the 200-day average. We saw it was working there. I would assume it's still working. So where's the support in the market? Probably the Bollinger Band. The Bollinger Band, the black dashed line, has been offering support on and off for a long time. It will for a long time. And the wider the range, the more support. Now, when you start narrowing in, what you'll tend to see is as the market hits it, it bounces away from it. You didn't hit it today. You missed it by about $2 roughly, $1.40 to be specific. So what? Coming down, I'd still look for support against it, bouncing back in here, but what I'm going to call just whipsawing overall, not going anywhere. Okay, I can live with that. Momentum is with it. We had some upside momentum as measured by the slow stochastic, and when it started abating, we're getting this break in the market. So momentum is flat. The bias I define as down since prices are under the 18-day average of closes, which is in the red, and support comes in at the lower Bollinger Band. In the differential of gold versus silver, I'm still with the Feb gold, so that's the cash market versus, well, actually, it's the most active traded market in futures versus the silver, but I want to switch over to the April shortly. In any case, it's underneath the 18-day average of closes, which means silver on a relative basis is still in a mode where the lower this number drops, the stronger silver is. You need less amounts of silver. These are ounces you would need in a perfect world to get 1 ounce of gold. So right now it's 68.14 based on this ratio. In silver itself, and I had on here the SLV a moment ago, I just took it off. They look identical, by the way, if you watch them. You have a pattern of a lower low, but today's action, you've got a higher low from that. So I have higher lows. I'm over the 18-day average, which is upside bias, but I have momentum pointing down. Everything is not in sync. If you're a buyer of the market, because the bias is up and the swing line's up, what you don't want to see taken out is 26.35. If it's taken out, the odds are strong you're going to try to make a run for the 18-day average, and we'll see what happens there. But in the meantime, the bulls have wrestled back control, and as a bull, I would not want to see the 26.35 taken out, and I don't like that momentum is still pointing down. In the copper market, how many times do you have to be hit over the head to understand you've come to the Bollinger Band and it keeps finding support against it? The market is drifting here. What it has changed, and it's always important to notice a change. The market was staying between the 18-day average and the upper Bollinger Band, and as we got into the end of January and where we're at now, it changed gears and became weaker. Now it's between the resistance of the 18-day average and the support of that market. The trend is down, the market is oversold, and the bias is down. Resistance is at the 360.30 level. You go neutral in the market if you hit 361.30, taking out that high that we made 2 days ago. In the platinum market, the swing line is down, the bias is up, and momentum is flat. This market enters an all-out sell signal on any close under 1097.30. So the battleground is that 18-day average. I'm not seeing an uptrend to hang on to, and I don't see a reason to be short. In the palladium, a very important day. The market closed at 23.26, rejecting what we call an embedded status. Now let me show you what this is. Both numbers on Tuesday in the slow stochastic were under 20. They were under 20 on Monday, and they were under 20 the day before. As long as you have 3 days or more where they're under 20, I call the market having successfully converted from being oversold to being embedded, locked in. The moment the red line closes over 20, especially over the number 21, my attitude is you want to be out of short position because often the market makes a run for the 18-day average of closes. Some traders will play this as what they call a lost embedded slow stochastic trade, and they'll put a stop under the most recent low in the market looking to see if price and that 18-day average can come together. The only time you can re-embed right away without going through that 3-day process or more is on the day after you lose the reading. And it has to happen right away. So I'd be looking in the evening session. If the market's up anymore, the odds favor it's not going to re-embed. And the traders, as I'm telling you, it wouldn't surprise me if they make that move. As for the dollar index, I've been telling you that I think the pros have come out of the market here. You have an overbought market that's fighting the upper Bollinger Band. It is not a sell signal in any manner. It is a signal. There's a difference between a sell and taking money off the table. That's what I'm seeing. Let's assume that I'm wrong and the market surges. 91.90 is the next target. If you get back under 90.33.5, you break the uptrend. If you like this type of analysis, you're probably going to like a lot what we do in all the markets at Linn and Associates. We have seasoned pros that are writing all day long. In fact, if you have our charting software, you'll hear all through the day commentaries, oral commentaries from David Hightower, from grain people, soft commodity people. We talk all the different markets. Then we write about them. So when it's all in here, and these are the markets that we cover throughout the trading day, quite a bit of information on Saturday and Sunday as well. So that's something you don't get in most places. If you haven't tried this, we want to give you a free trial. No credit cards, nothing. Just give us a call. You can go to our website. On the bottom right, you'll see free offers and a host of other ones that I have. Take advantage of them. I'm Ira Epstein. I'll see you tomorrow.